Homebuyer Education, Section 5, Borrowing for a Home, How Lenders Decide to Loan You Money. Finding out what you can buy. Rough estimates. Rough rule of thumb number 1. Housing costs should be no more than 25% of gross pay or 35% of take-home pay. Housing costs included utilities, insurance, maintenance. Pre-qualifying. Preliminary look to determine how much you might borrow. Lots of calculators for estimating affordability are available online. Benefits for pre-qualifying generally involves using a worksheet. Pre-approval, formal process to determine exactly how much you can borrow. Requires you to submit info and supporting documents. Generally results in a letter stating 1. How much you can borrow. 2. Specific term for the terms and amount of the loan. Can be difficult to obtain. Pre-approval is popular. 4 C's of credit. Capacity. Gross monthly income. Income before deductions. Steadily employed for at least 2 years and can be documented as reliable income. Remember, you must document your income. Capital. Down payments demonstrate your commitment. Savings must be entirely under the control of the borrower, and gifts from household members are okay if documented as unconditional. Assets must convert to cash prior to closing if required for down payment. Credit history. Lenders want to see how much you owe, how often you use credit, that you pay on time. Collateral. If you cannot make your payments, the lender gets the house in foreclosure. The lender will then sell it to get his money back. Most lenders will loan a percentage of the value of the house. Lenders think of your debt in terms of ratios. Front-end ratio compares your total monthly housing, mortgage principal and interest, real estate taxes, and insurance with your gross monthly income. Back-end ratio compares all monthly debt payments, housing expenses, plus other consumer loans such as car payments and credit cards. Qualifying ratios, the front and back-end ratios required for a particular loan. Special loan products. Special loan products, such as those for persons with disabilities, may allow higher percentages of housing with total debt. What you can't borrow. Down payment. Money paid to a lender at closing, that is the difference between what you are paying for the house and the amount of the loan. Sources of down payment money. Lenders like to see the down payment coming from savings by the buyer. Can use a gift from another household member if you can prove that it is a true gift. Loans cannot be used for down payments. Grants can be used. Down payment assistance programs can be used. Closing costs. Not usually borrowed, but can be a true gift from parents or others. Result from different parts of the purchasing process. Cost associated with the loan. Cost associated with obtaining title to the property. Cost associated with real estate transfer taxes. Cost associated with service providers. Taxes. Assessments for neighborhood associations, if applicable. Negotiate closing costs. Insurance associated with the loan. Title insurance, private mortgage insurance, PMI. Federal law regarding PMI. Conventional loans closed on or after July 29, 1999. For loans closed prior to July 29, 1999. Borrower initiated cancellation. Automatic termination. As of January 31, 2013, the HUD mortgagee letter. What lender needs to know to give you a loan. Personal identification. Information on your residences for the past 2 to 6 years. Banking information for all bank accounts. Employment information. Information on debts. What happens when you go to a lender? Expect lots of questions. Be prepared to provide the needed documentation. You will sign letters or releases. Discuss any housing purchase assistance you have or let the lender know. Ask lots of questions. Things to remember. You need to supply complete information that encourages the lender to trust you. Supplying information in a quick and orderly manner. Be patient with the process. The law only cares about what you sign. If your loan is denied, you have the right to be told why. Make sure your credit records are correct. You can apply somewhere else, but be careful. You can take the reason you were denied and use it to plan your next step. Use the good faith estimate to shop and compare loans. A GFE lists all costs and fees you will expect to pay at closing cost. You will receive a form from each lender. APR combines interest, fees, and all costs and expresses them as a percentage rate. The Center for Responsible Lending warns that too much focus on APR can reduce awareness of unfairly high fees.